The Dow and the S&P 500 could be cut in half in value, and they'd still be overvalued.
SD Bullion and Australia's famed Perth Mint are offering silver investors a free 2019 Perth Mint Silver Kangaroo Coin. Only while supplies last. When you purchase 24 brand new Perth Mint Silver Kangaroo coins, you'll receive the 25th silver coin for free. These 2019 silver bullion coins will come officially sealed and delivered in protective Perth Mint tubes. Visit sdbullion.com/free to claim this limited time offer.
Hey everyone, this is Elijah Johnson with silverdoctors.com, and back with us today is our good friend, fund manager David Kranzler from Investment Research Dynamics. Dave, thank you so much for joining us today.
Thanks for having me back on, Elijah. It's good to be here.
All right. Now, we're seeing, I know last time we had you on, you were talking about how you were very bearish on the stock market, and you thought that there were going to be, coming days where the stocks continue to go down. Now, that's what we're seeing right now. It seems like we've had counting today, about 5, maybe 6 days in the stock market where it's down. So what is happening right now? Is this the beginning of the end, or is this just like a little bump in the road?
It's a good question. Someone was asking me if we might see capitulation this week, and I was like kind of taken aback by the question. I mean, capitulation is what you normally would associate with the last big violent move at a bottom. And I pointed out, I said, look, the Dow and the S&P 500 could be cut in half in value, and they'd still be overvalued. And so, I mean, to ask whether or not we might see capitulation this week, maybe short-term capitulation where we have a sell-off and then a bounce. But I do think that we're in a cycle now where we're going to start seeing rallies being sold or shorted and sell-offs being, people trying to buy the dip, and then also short sellers, taking short-term profits on part of their position. In other words, I think the way the fundamentals are lining up, I mean, you've got the housing market and the auto industry are headed south. I think the housing market's heading more quickly south than people are expecting or realize can and will happen. And you're talking about, between autos and housing, you're probably talking about 50 to 60% of the U.S. economy, and probably more when you include all of the related businesses associated with the process of building and selling homes and financing homes, and same with cars. So, I think in 2018 we saw most of the profits were non-GAAP as adjusted. A lot of it was non-cash. A lot of it was related to the Trump tax cut. Those are one-time things. The non-GAAP, non-cash profit recognition. Eventually, you run out of those gimmicks that you can use. And so I guess my point here is I think we'll start to see an earnings contraction. Interest rates are rising. And, regardless of what Trump whines about in terms of beating up the Fed for raising interest rates are going to go higher with or without the Fed. And a big part of that is the enormous amount of debt the U.S. is going to have to sell. I was originally thinking that the U.S. government might have to issue around $1.5 trillion worth of debt this year, but on a trailing 12-month basis, they've already issued over $1 trillion of new debt. I think it's possible that we could see as high as 1.7, 1.8 trillion of new debt issued in the current government fiscal year, which is fiscal year 2019. And all of that's going to cause interest rates to go a lot higher because the market's going to have to absorb all that debt. And as the market naturally takes interest rates higher with or without the Fed, it's going to be like, throwing hand grenades into the stock market. And so I think October and what we've seen this week is just a small taste of what's to come. Because let's not forget, when Trump was running for president and fighting for votes, he referenced the stock market as being a big, fat, ugly bubble. And the Dow was at 17,000. So the Dow's now at 25,000. So, if it was a big, fat, ugly bubble at Dow 17,000, I mean, what is it now?
Right. And you're talking about a deficit, right? You were saying like $1.8 trillion. That would probably make it the biggest deficit in U.S. history, right?
Well, that would be a record issuance of debt. Now, the government hides its true deficit. I mean, it reports a budget deficit, but there's also a spending deficit, and they have what they call on-budget and off-budget items. And the off-budget items are expenditures that don't show up publicly in the published reports. I mean, they're alluded to, and politicians allude to them, and we know they're there. But the way to tell exactly what the spending deficit was in any given period of time is to just look at how much Treasury debt has been issued. And that's, there's a website out there, Treasury Direct, that publishes on a daily basis the amount of, it's not that debt clock that you see, but it's actual, the amount of debt that's out there on a daily basis. And so, the government has expenditures and it's got revenues. And when expenditures are higher than revenues, they have to issue debt to make up the difference. So that's how we know that you can measure the true spending deficit based on the amount of the increase in the amount of Treasury debt outstanding.
Definitely. No, essentially you're saying that, one of the ways that we know that the debt, how the government reports the debt seems to be a bit strange is that they don't count all the unfunded liabilities, right? And if you use generally accepted accounting principles, wouldn't you count, unfunded Social Security and Medicare and Medicaid?
You would, but that would be on a GAAP basis, and that's not really. A lot of those unfunded liabilities will never be funded. They'll never be paid for. They'll be defaulted on, and so you don't even need to look at those. The funded liabilities, the Treasury debt outstanding, that's going up now at a trillion and more than $1 trillion a year. That alone is going to be enough to undermine the system. I think Treasury debt, just Treasury debt as a ratio of GDP is something like 108% now. And that doesn't even include the Fannie Mae and Freddie Mac and guaranteed mortgage debt that you need. You really technically should add that on, and that adds on another 9 or 10 trillion of debt. So, the unfunded liabilities are fun to talk about, and you're right. Technically, if you were to use GAAP accounting, then the deficit would be a lot larger every year. But again, I just toss those aside and laugh at them, and because the deficits that the governments are incurring now and the amount of debt they're issuing to cover those deficits, that alone will be enough to undermine the system eventually.
Right. Now, you're saying that there's going to be this large increase in the deficit coming next year, I believe is what you said. And then also, you've been reporting on the housing market. Now, how is this? Are these going to coincide, and how is this all going to affect the housing market? Because you see a housing market collapse coming soon.
Well, I think it started. I think it started. I was just reviewing an article that I had bookmarked, set aside about 2 weeks ago, and of all media sources, CNBC actually published it, and it was talking about how sales in Southern California were down 17% in the month of October. And then there was that article in the Seattle Times that was talking about the massive spike up in inventory and decline in sales transactions. I don't recall what the percentage decline was for Seattle off the top of my head. I saw a report on Las Vegas that was detailing early October sales in Las Vegas, and those were down something like 18 or 20%. One of my short seller journal subscribers is a realtor in Texas and in the Dallas-Fort Worth area, and he sent me an email about a week ago, and he said, based on his preliminary calculations, he said it looks like pending sales, so basically based on contracts signed in the Dallas-Fort Worth area, we're going to be down, at least 20% in October. So, we're seeing reports like this from all over the country. And, I think the same thing, actually, there was an article in the Denver Post that talked about September sales, and those were down, double-digit percentage amount year over year. So I think the collapse is starting, and higher interest rates are just one component of it. There's a lot of components. I mean, there's the affordability issue, rates factor into that. But I also think, if you look at the government lending programs over the last several years, they've lowered the bar in terms of what it takes to qualify for a Fannie or Freddie mortgage, and a lot of the paper the government's backing is mortgage debt that would have been classified as subprime 10 or 15 years ago, and now it's guaranteed by the government, gets a AAA rating on it. So, so the government expanded the pool of people who were eligible and could qualify for a mortgage. A lot of those people can barely afford the monthly cost of home ownership. And I think we're at the point where that pool of people is tapped out. So in order to expand the pool more, the government's going to have to lower the bar even more. And they really can't take the bar much lower other than outright subsidizing interest rates, by saying, okay, now we're going to give you a zero down payment, zero interest rate mortgage for those who qualify. And as long as your credit score is over 600, you'll be considered non-subprime. So, and it's guaranteed by the government. So, the government itself made the problem into what it is. The government combined with the Fed. And, it's starting to hit a wall. And I think, I recall the housing collapse in, the Big Short, the mid-2000s housing collapse. I recall the late 1990s, early 2000s, somewhat related to the tech bubble popping. I recall the real estate crash that happened in the late 80s and the early 90s related to Drexel and the S&L crisis, among other things. In fact, I could even take it back to the real estate collapse that occurred. I don't remember if it was countrywide, but it definitely happened in the West related to the price of oil going down in the early 80s. So, people don't realize, just as quickly as housing prices and sales transactions can run up in volume and price, when it stops on a dime and then it falls. Because at the end of the day, when the market's strong, people treat houses like they're stocks. Oh, I'm going to go out and flip some houses. And it's the market's liquid. But when the market starts to head south, it becomes very illiquid. And in general, a house is an illiquid asset. And so when the bid side pulls away, it pulls away quickly and it drops in step functions. And I think we're about ready to see that.
Now, a lot of people, and we've talked about this before, have pointed to, in these kinds of crises, turning towards precious metals. I feel like a lot of people might be getting discouraged right now as we're seeing silver dipping below. We saw it dip below $14. We haven't really seen these prices. It's near a 3-year low if you look back to December of 2015. So what is your perspective on what is happening right now to precious metals?
I think precious metals market is probably where we're seeing some capitulation. And at this point in time, gold is being very sticky at 1,200. I know a couple nights ago it got taken below 1,200, and then it bounced back above. And I'm talking the December futures basis. The price bounced back above 1,200 pretty quickly. And so, it seems to be ping-ponging between, call it 1190 and 1220, 1225. And, at some point it's going to push above that level. And then I think we'll probably see a move back to 1300 pretty quickly. But if you look at like the mining stocks, have outperformed gold since, let me just get this up here, since early September. And for as negative as the sentiment is in the mining stock sector, I'm looking at the GDX mining stock ETF. I mean, it bottomed out in early September at 1750, and it's pushing 19 now. So it's not a bad rate of return over two and a half months. If you just bought the GDX ETF. And when I look at that chart, it's showing, it's at least now, and again, we need to see the whole thing play out going forward, but at least right now, it looks like the mining stocks might have bottomed out in early to mid-September. Now, the GDX is a larger cap. It's based on a larger cap mining stock index. The juniors are still getting hammered, and I think part of it is related to tax loss selling, because I've had several subscribers email me and ask me, about tax loss selling, blah, blah, blah. And it's like, well, if you like the stock, don't sell it just to save a few pennies on taxes. If you don't like the stock, then sell it and take the loss and use the money somewhere else. So, the point there is, I think the juniors it's largely, retail type investors who own the juniors. And so I think you're seeing a lot of people, capitulate, sell their juniors, frustrated, take the tax loss and move on. But you're definitely seeing, at least there's been a nice gentle uptrend in the larger cap mining stocks, and I'm looking at the chart right there. So, I think a lot of people who don't really look at the big picture would probably be surprised that, over the last 2.5 months, at least the GDX index has thrown off a positive rate of return. So it seems like it used to be that gold and silver would lead the mining stocks, and then the mining stocks would take off and substantially outperform the metal. It seems like over the last few years, it seems like the mining stocks, especially some of the more speculative ones, seem to sort of start showing performance before gold and silver do. So, I don't know if it'll happen that way this time around, but I do think that at least all the financial and economic fundamentals are lining up in a way that should be very bullish for gold. And by the way, a rising dollar doesn't necessarily mean it isn't necessarily bearish for gold. Some of the best rate of return periods for gold over the last 18 years have been when gold and the dollar have risen in tandem, and we've saw that to an extent during the month of October, and I happened to notice it earlier this week. There were days when gold was up and the dollar was up, or gold would be up and the dollar would be flat. So, and the other myth out there is that gold can't go up when interest rates are rising. Well, again, statistical studies that I've seen that go back to the early 70s show gold has its best periods of rate of return during a period when the Fed is raising interest rates. So, right now we've got all those ingredients lined up for what could be a big move. I just have no idea what the timing is on it. And believe me, I'm as frustrated as everyone else. But, it's this. I've learned to live with this type of action in this sector over the last 18 years. So, People have to remember these aren't tech stocks where everybody and their cab driver or their Uber driver piles into them when they're moving higher. It's not a well followed, well understood sector, which is what I like about it, because it means there's plenty of opportunities to make a lot of money in stocks that don't end up, featured on CNBC or in everybody's newsletter.
Definitely. And if people are interested in learning more about your research on this, where can they find you?
My website's investmentresearchdynamics.com, and I have two links at the top. One's for my mining stock journal, which is a biweekly subscription service. I publish it and send it out every other Thursday. And then my short sellers journal, which is kind of self-explanatory, and that's a weekly that goes out sometime on Sunday, usually Sunday early evening, late afternoon, that type of thing.
All right. Well, David Kranzler, thank you so much for your time today. Before we let you go, any last thoughts before we leave you?
Yeah, I hope everyone just, maybe for the next week pulls back from the stock market and tries to enjoy a Thanksgiving holiday, because who knows how, given the chaos that we've seen in the country over the last few years, who knows what type of environment we're going to be in next year. So, I just think you got to enjoy what you can as much as you can while you still can. And I hope everyone has a happy Thanksgiving holiday.
Awesome. Dave Kranzler from Investment Research Dynamics, thank you for joining us, and happy Thanksgiving.
Thanks for having me on. Same to you.